All right, welcome everybody. It's almost Songkran, so I'm sure everybody's getting ready for your holiday, I hope. And I am going to be working over Songkran. I just love work. There's so much stuff I want to get done, and it's great when everybody's gone because then I can take my mom out for lunch at fancy restaurants with no traffic and parking. So, and then my mom and I are going to go to a staycation for the weekend at Shangri-La Hotel. So I'm excited. So you'll notice I'm going to be turning sometimes because that's where the screen is over on the left where I can see your comments. So sorry about that. First of all, I see ABB. Happy Songkran Day. John, Andrew, thank you very much. And same to you. Let's see. Hold on. So Anita says, Happy Thai New Year in advance at John Andrew. Yes, good to see you. And Salaya DC, Sawadi Be My. Yes, fantastic. Good to see you guys. I'm turning my head because I'm just looking at the comments here. Tarin Rat says, Sawadi Kap Kun Andrew. And all right. Bunasan says, hello, John Andrew. Happy holiday. I think everybody's in a holiday mood. I think so. Where is the fancy restaurant? Well, feel free to give any suggestions. My mom's favorite is Limoncello on Sukhumvit, Soy 11. But we love to go to any great restaurants around. All right. Well, tonight we're going to go through our strategies and we're going to take questions. There's so much going on in the world these days. So I thought it would be good to talk tonight. I just want to welcome everybody here. And I know you got a lot of things you're doing in your life. So it means a lot to me that you stop by and, listen and ask questions and participate. So that's fantastic. So why don't I get started? And I'm going to start by, there we go, sharing my screen. So we're going to be talking about all-weather strategies and a review for 2023 March. So remember that you can ask any questions in the chat. I love questions. Feel free to ask them, and I'll do my best to answer. I just wanted to remind you, I thought it's a good time. Markets are so up and down these days, and there's just so much unknowns and questions that people have. I wanted to remind you that our strategies are global, right? We invest globally, not in Thailand, not only in Thailand. There is a small part of our investment that's in Thailand. And long-term, we try to gain from long-term equity return while trying to reduce the damage during equity market downturns. But we can't help but be affected by equity market downturns too, but we're just trying to make sure that we don't get a huge downturn. And then diversify globally across asset classes, regions, sectors, and companies, depending on which strategy we use. Now, before we go further, I have to check out the restaurant here. Okay, hold on. We got a restaurant recommendation. Rosano's Italian restaurant at Asok. I don't think I've been there, so I'm going to have to check that one out. I will definitely look that one up when I get off of this call. So thanks for that recommendation. If anybody else has good restaurant recommendations, make sure to put them in the chat so we can all see them. Nothing better than a great time at the restaurant. All right, let's continue. So I also wanted to remember why we're here. What are we trying to do? What we're trying to do is build wealth over the long term. We're not here to try to catch the market and catch the latest trend. We're trying to build wealth over the long term. And I just thought I would highlight a couple key principles that we're trying to follow. One is to be broadly diversified. We're not invested in individual stocks. We're invested in mutual funds. And those mutual funds are exposed to the different asset classes, stocks, bonds, commodities, and gold. And so we are broadly diversified. Also, it's important that you contribute regularly. One of the big mistakes that many people make, particularly at a young age, is that they don't contribute. And they may invest once and then they leave it. But to grow wealth over time, we really need to contribute regularly. And the last thing I just wanted to highlight is to stay invested. And I like to build our strategies so that you can feel comfortable being in the strategy for a long time and not feeling like you've got to get out and then you got to get in or that type of thing. Okay, before we go further, Rachini says Zenoti in Saladang. Yeah, I remember when Zenoti opened many years ago. It was amazing. And then now there's so many other great Italian restaurants. And but I haven't been to Zenoti in a long time. So that's a good recommendation. Excellent. Okay, back to the show. All right. So the other thing that I wanted to do was highlight what I call my 12 steps to financial independence that I talk about in the book, How to Start Building Your Wealth, Investing in the Stock Market. The first one is create a plan and follow it. The second one is keep investing simple. The third one is start early because time really is money. The fourth one is get real and realistic about stock market returns. Number 5 is do it yourself. Now, part of what we've done with the all-weather strategies is to do it for you, for those people that just say, I don't want to do it myself. And avoid mistakes when you're young. Build your wealth through savings. Keep your financial costs low, and that's what we're trying to do with these mutual funds. And number 9, diversify to reduce risk. We are strongly diversified and own both stocks and bonds. We own both stocks and bonds in all 3 of our strategies. Trade infrequently. We revisit the portfolio every 3 months. We don't trade in between that. And stay invested and watch it grow. Those are the 12 steps that I talk about in my book, How to Start Building Your Wealth, Investing in the Stock Market. I just thought it was good to come back to this for a moment. And let me speak to you just for a moment about this. I have 5 nieces, and when each of them got to high school, I flew home for their high school graduation, and I brought $3,000 in cash with me, and I gave it to them as a present. But I told them that they can't spend it. I'm going to help them set up an investment account at Vanguard at that time. And then I knew that none of my nieces knew anything about investing, so I had to come up with as simple a way of investing as I could. And that's what I did. And that's why I wrote this book. And so I just want to highlight that the purpose of the book is to help people to invest carefully in a smart way. All right, we'll go back to the presentation. And also remember that in addition to the book is also in Thai language. So you can find it online at Central, at thaibookfair.com. You can find it at CED at the bookstore or online. And you can find it even on Shopee in the Thai version. And of course, you can find the English version on Amazon. So don't miss it. It's not an expensive thing, and it helps to build the foundation. Also, some of you have decided to join the course. So you can join the How to Start Building Your Wealth, Investing in the Stock Market course, which I also have in Thai language as well as English. So there's many ways that you can get these foundations so that you know what it is that we're doing with our portfolio. And I'll just put a link in there in the show notes, in the comments, where you can see more about it. All right. So I just thought I wanted to take a moment to see, again, kind of step back. What are we trying to do? We have 3 strategies. The red line is the all-weather strategy, which was started in 2019. And it's had its ups and downs. And recently, if we look at it right now, I'm going to just grab my pen here for a second. If we look at it right now, it's been a hard time. We did really well. And then the market really, let me get a black pen here. Hold on. The market really struggled. And so we've seen a pretty strong down market, and then we're in kind of a flat market. Now, the next one we started was the Alpha Focus, and it's been a bit of a tough time. That's a more volatile one because we're trying to get more equity exposure. So just like we saw a fall in all weather strategy, we have seen a fall in Alpha Focus. Of course, that fall went from 100 to 90, but as I'm saying to you, we want to think long term. And then the final thing is Inflation Guard, which the objective of that was, well, our objective is that this grows very slowly, but it doesn't move around much. And that's exactly what you see. So the first one was all weather strategy. The second one was Alpha Focus. And the third one that we've launched is the Inflation Guard. I just made that chart today because I felt like it's a good way to understand what we're doing. So AWS launched in February of 2019, and we target a 6% annual return. Our AWAF, or Alpha Focus, launched in October of 2021, and we target an 8% return because we're more aggressive with that one. And All-Weather Inflation Guard was launched in July of 2022, and for that, we're targeting 4% for people that really don't want to take on much risk. Those are our goals and our objectives for these strategies. So now let's go back just a very short amount of time till July of 2022. And what we can see is that if we start at July 2022, why are we picking July 2022? Because that's the point that we started the all-weather Inflation Guard was in July of 92. And so if we were to rebase all three of them to that point, we can see that from when we started all-weather Inflation Guard in July of 2022, the strategies have performed as expected. It's been a tough time in the market. Ranking the strategies by return shows the highest risk all-weather Alpha Focus has had the highest return, and the moderate risk all-weather strategy ranks in the middle, and the all-weather Inflation Guard has a very low volatility. That's the green line, and that's our objective. Now, since July, the same period of time, all-weather Alpha Focus is above world equity, and all strategies have had much lower volatility. This is really a chart that shows what we're trying to do with these strategies. We're trying to eliminate the extreme downturns, and those extreme downturns we eliminate through bond exposure and through gold exposure, and also through sometimes defensive equity exposure. So it's important to remember that we create our strategies for many decades. However, not even a decade is really long term. Here's a picture when I was a little boy, and that's me when I moved to Thailand, and that's me when I'm 100. Our aim is to create these strategies that perform over many decades. So sometimes you'll see that I don't get particularly caught up in the market. You won't find me all excited or really down because I know that we're doing the right thing with these strategies over a long period of time. All right, let me take a moment and stop there and just welcome everybody. I see that we've got 126 people in the call. I just want to welcome you all into the call. And I'm going to be going through our strategies and then talking about what's happening around the world and taking your questions. So remember, now's the time to start writing any questions that you have. Even if you think it may be a silly question, I bet you someone else is out there thinking they want to ask the same question. All right, back to the presentation. So we're going to review our performance. An all-weather strategy for the month of March was up 2.2%. Alpha Focus was up 0.8%. And all-weather Inflation Guard was up 0.1%. And then we're going to look at the global outlook that guides our asset allocation. So let's look at all-weather strategy. We call it global, long-term, and diversified. And here we can see that since inception, the strategy was 5.2% above a 60-40 portfolio as of 10th of April, 2023. The strategy was about 0.5% above the 60-40 portfolio for the month of March. Our 25% allocation to gold drove the outperformance. So we've got that one right. And we've had 25% in developed Europe and Japan, which were only beaten by the US, which the US has done very well. And we have a very low exposure to the US. Now, the strategy over the past month, the strategy was on par with the 60-40 as of the 10th of 2023. Again, our gold helped us, and our developed Europe and Japan didn't help us for that period. Now let's look at the all-weather alpha focus, which was up 0.8. This one also is global. It's opportunistic. We are oh God. And we're looking for opportunities. And we also are long-term. And most importantly, because we're more aggressive with this one, we try to be defensive. Now, since inception, the strategy was 1.1% below the 60-40 portfolio as of the 10th of April, 2023. So it's been a bit of a rough ride since we started, but ultimately it is a strategy where we're trying to take on more risk than the all-weather strategy. If you had invested in the world equity only instead of alpha focus, you would have underperformed. So the strategy was 5.2% above world equity as of the 10th of April, 2023. And here we can see for March, the strategy was 0.8% below the 60-40, and the strategy was about 1.9% below world equity. Our 15% tilts to Europe and small caps and world energy and a relatively high bond allocation after taking a hit in world financials. If you remember, we went into a 7% position in world financials, and then we exited that position very quickly. Once the Silicon Valley Bank situation happened, we thought it's just not worth it to be exposed to financials right now. That led to some of our underperformance. But overall, I would say if we look at the performance, let's just look at the alpha focus. We did lose. If you see some of our underperformance here, we got back, even though we got hurt in the financials. So I'm happy with that performance. In the past month, the strategy was 0.9% above the 60-40 portfolio as of the 10th of April. The strategy was 1.4% above world equity, and precious metals, miners, and world energy were strong. Also, defensive sectors like healthcare and infrastructure did well. So now let's wrap up by looking at inflation guard. Remember that inflation guard is also global. It's also long-term, and it is very defensive. Here we can see that since inception, the strategy was 1.8% below a 40-60 portfolio, meaning 40% equity, 60% bonds. So it's underperformed. The strategy experienced less volatility, though. You can see that the red line is more straight than the blue line. And here you can see in the month of March, the strategy was 1% below the 40-60 portfolio. And except for tips, bonds held up well. And our 10% gold allocation did well, while our 5% in world energy took a hit. The World Equity Fund underperformed the MSCI World Index during that period also. So in the past month, the strategy was 0.1% below the 40-60 as of the 10th of April. Our largest allocations to medium-term bonds and world equity has fallen, and world energy has now rebounded, and we have a 5% target allocation there. So let's look at the outlook as we see it. So I'm going to sit down and go through that. So just 1 second as I shift down my chair and my desk, and I see that Mohammed Abdul Alim says he's got to go for prayers. I know it's Ramadan for all of our friends in the Muslim and Islamic faith. So it's a time for people to start breaking their fast now. So also it's time to do that. Okay, let's continue. And we're going to look at equity. And without a crisis or oil shock by 2020, the end of 2023, I believe that US CPI could be down at 3 to 4%. US CPI is falling fast. And in the euro area, inflation has also slowed down very fast. This has led to a more positive outlook on Europe. Now, the battle against inflation isn't over. High inflation will likely persist for a while, meaning it's not going to get back down to 2%. But in the long run, equity is the best hedge against inflation as companies have to adapt to survive. Now, in May, the Fed hike. The Fed is expected to hike, and what we can see is the market is pricing in a 71% probability for another 0.25 rate hike at the next meeting. Let's look at the expected rate curve and how it's shifted. You can see that the rate curve has shifted down, and the dotted line is March, and now the solid line is April, and we can see that people's expectation was that by July of 2024, previously they thought that eventually the Fed would start bringing down rates from a peak of 5.5 down to 4.3. And now market expectations have dropped by 1 full percentage point here. And we can see that people are really expecting the Fed is going to be bringing down the rate. So recent events in the U.S. bank sector have led to a shift in expectations. And the peak is now expected at 5% in June versus 5.5 in July. The market thinks the Fed will pivot rather than keep rates high for some time. Now here's the chart we've been looking every time we meet. We look at this and we look at the yield curve. And we know that the yield curve has predicted all recessions in the U.S. since 1968, when the yield curve is inverted. That means when we subtract the 10-year, the yield on the 10-year bond from the 3-month bond, if that goes negative, in other words, 3-month is higher than 10-year, then this goes to this point. And what we can see is that the average time from inversion until recession started was about 1 year. So basically, I would say from everything I've seen that by June or July, the U.S. is going to be in recession. And that's part of the reason why we have a lower level of exposure to the U.S. market. Now, there hasn't been much QT in the U.S. We can see it came down. The Fed's balance sheet came down. So I've taken the central bank assets here. I've rebased them all to 100. And then I've said, and that's January 2020, so just before the COVID crisis really hit, there was a huge expansion in balance sheets, and we have a tiny amount of quantitative tightening. And now the Fed is on to quantitative easing. And I would argue that we are now in quantitative easing, and really quantitative easing infinity. Mainly, central banks have let bonds mature, which has led to little change in their balance sheets. And the ECB has recently dropped its balance sheet. The Bank of Japan's balance sheets began to grow in October, and the Fed's has grown in the recent bank crisis. Now, for the past year, we've said that we think the course will eventually be reversed. We think that the central bankers and politicians will change course and return to accommodative policies as soon as something breaks. And we do think that something's going to break. In fact, the recent Silicon Valley Bank situation has really shown one of the things that can break, which is the banking sector. Now let's look at bonds for a bit. Bonds are typically a safe place to be, even though 2022 was exceptionally bad. In recessions, safer assets like government bonds typically have performed well. Though with high inflation, low yields could still lead to negative real returns. Now, we generally don't allocate to bonds to try to speculate on the upside, but rather we use the bonds to protect capital over time. equity is where we want to get the upside. Let's look at commodities. Here you can see the incredible rise and fall of European natural gas. Again, I rebased to 100 right here, and we can see an enormous rise in European gas when the war started between Russia and Ukraine. It then eventually came down, and that's part of the reason why inflation is down in Europe. Though it could be on the rise again due to recent production cuts by a number of OPEC plus members, but you could say for right now, they've done a pretty great job. It's hard to say if it was just a knee-jerk reaction or if energy prices will regain momentum. Food prices have also continued to soften now on the food price index that started at about 65. It went all the way up to about 160, and then it came back down to 127. If the trend continues, it helps to lower the pace of inflation. Now, commodities have lost momentum as energy prices eased due to a mild winter. We currently don't see a clear catalyst for energy prices to go significantly higher, but we think that they can remain high, which supports profits for energy companies. The main upside in commodities would come from a supply shock, adverse weather conditions, or significantly higher demand, for example, if we have a China reopening. And finally, gold. Central banks have been loading up on gold, maybe switching from US dollars into gold. And here we can see that the gold price over a long period of time, and the recession risk remains. We keep a relatively high gold allocation in our strategies, which also serves as insurance in times of uncertainty. In general, gold protects value in times of uncertainty and market downturns. Now, what are the risks? Risk number one is that inflation accelerates. Central banks' aggressive rate hikes and quantitative tightening is also a risk in that it could crash the market. And I do think there's a risk that the US market could get hit. Collapsing energy prices will be damaging to our tilts towards world energy. And if inflation reaccelerates, we could miss out on commodity prices because for most of our portfolios, we've reduced our commodity exposure dramatically. Now, our high gold allocation could get hit by higher rates or if market sentiment improved. So the key takeaways are equities appear more attractive when we overweight Europe and Japan. We see opportunities to allocate to specific sectors within equity like energy. We have gold to protect capital. And then our risks are inflation reaccelerating, rate hikes crashing the market, collapsing energy prices, Europe and Japan underperforming, and a falling gold price. If any of those things happen, it will hurt the performance of the strategies. Now, before we get into Q&A, we're about to start Valuation Masterclass Bootcamp number 9, which starts on May 1st. We're just in the final week of this one, and it's really exciting. And Kunsupakon, can you see your daughter there? There we go. So we've got a lot of great students from around the world. We've had a lot of great presentations, and really, really has been a great time. So we're looking forward to the next boot camp. Our limited super early bird price is still available. And with the phenomena, you can save $100 off of that. So you get $100 off of any price point until April 21st. So you save $800. You can use this coupon code. Just type in phenomena by going to valuationmasterclass.com/bootcamp. And I included the links in the show notes there. All right, it's time for Q&A. Let's talk. Supercon says, seems that high interest rates impact higher than the Fed expected. High interest rates impact are bigger than the Fed expected. Yeah, I think the Fed knew that the banks were holding a lot of government bonds, and they knew that the banks would be suffering unrealized losses, but they increased the rates anyways. I think the thinking of Chairman Powell was the one thing he doesn't want to be remembered in history is the inflation getting out of control. And so I think he's put inflation as a top priority, and that's why he keeps raising rates and is keeping them high. And truthfully, Silicon Valley Bank and the other banks should have been trying to prepare as they saw interest rates rise. Now, it was a difficult situation, but yes, I would say that. Peachit says, what is your opinion for semiconductor and AI mutual funds? Semiconductors is interesting. My students in the Valuation Masterclass Bootcamp have been valuing SMIC and recently TSMC. And I think there's a lot of risks there for TSMC, particularly their expansion to the US. I think it's going to cause prices to go up quite a bit. And that's going to be hard for their customers. In addition, it's going to be an opening for, let's say, Samsung or competitors that are in places in Asia, because we know the prices are lower. The cost of manufacturing is lower in Asia. So I'm kind of I'm neutral right now on semiconductors and AI mutual funds. I don't have a strong feeling right now. I think that there's so much geopolitical risk that worries me. So that's where I'm at with that right now. All right, other questions. Let me just remember if I had any other questions. We have good recommendations on restaurants, which I did see one that just came up before, which was ABB says Pan Pan. I remember when I arrived in Thailand in 1992, Pan Pan was the place to go around that time. Cash still flowing to money market mutual funds. And how is bank going to solve the low deposit interest? Okay, this is actually kind of a big question, and there's a lot to it. Basically, what happens since the 1997 Thai crisis, for the older people on this call, you may recall, and I remember when I moved to Thailand, the savings rate on deposits was 5%. And the return for a fixed deposit was 6 or 7%. The banks had to pay. But when the economic crisis happened in Thailand, the banks put their savings and overall deposit rates down to zero. And it was 10 years before the Thai banks started increasing their deposit rates. And the government and the central banks let them do it so that they would rebuild their capital base. This is how banks get money from the taxpayer, is by not paying much on deposits. It's the core strength of a bank, is to get low cost deposits through their branches. So now what we have is when the Fed, during the COVID time, when the Fed did quantitative easing, they basically pumped a huge amount of money into the economy. That money went into the deposits of the banks. So the banks had a 20% increase in their deposits in America, and they didn't know what to do with them. So what did they do with them? They put them in government bonds. They got a lot of deposits. They put them in government bonds. And remember that every depositor in America is guaranteed only up to a limit of $250,000. Anything more than that, and they won't get compensated if the bank goes bust. So when things get scary, basically people figure, instead of leaving my money in the bank where I'm only guaranteed $250,000, let's say they got $10 million in deposits, I'd rather put my money into a money market mutual fund, which is allowed to invest in US treasuries. So even though I'll be earning a pretty low interest rate on the treasuries, but it's not that low anymore. But the point is that all of my assets are in the safest asset in the world, which is US treasuries. And so we continue to see money coming out of banks and into money market mutual funds so that people get their money into the safest thing they can, which is treasuries. Now, this puts a pressure on the bank because deposits are flowing out and they have to sell bonds to pay back those deposits. And if they have to sell a lot of bonds, then they have to take a lot of loss. But the fact is that what the Fed did when the Silicon Valley Bank crisis happened is they said, we'll buy those bonds at par value at 1,000, even though we know they're worth 800. We'll hold them at the Fed for a year, and then hopefully the prices will come back or the banks will be in better condition, and then we're going to give those bonds back to you, and then you have to deal with them. And so with that type of program, it's free money for the banks. And so the banks can all, if they have a lot of deposits going out into money market mutual funds, they can take any of the government bonds that they have, and instead of selling them into the market at a loss, they can sell them to the Fed at even. So I think that we're still going to see flows out, depositors taking their money out of deposits at the banks and putting it into money market mutual funds. We've already had a huge flow of that, but I would say we probably will see more of that happening. The bigger question, I think, ABB, is, are we going to have a banking crisis? And I would say, yes, I think we still have a potential for a banking crisis where there will be runs on deposits, and then the banks will be trying to pledge the securities with the Fed. And I believe that the Fed is going to have to start buying mortgage-backed securities again. I think that's the next move by the Fed. MBS, mortgage-backed securities, because basically a lot of the regional banks have a lot of real estate exposure, and I think they'll want to get those off their books to get cash. All right, next one. Let's see. Sunny Yellow says, do you believe the United States will enter recession in this year? Yes. In 2 to 3 months, in June or July, I believe that America will be in recession. My evidence is the inverted yield curve. My evidence is the tightening of interest rates is supposed to slow down the economy. My other evidence is that the unemployment rate is at an all-time low, which happens just before recessions start. And other reasons why, you can already see in the chart I showed you that people's expectations are that interest rates are going to fall quite considerably over the next 12 months. So the market is expecting that to some extent. So the answer, hopefully, is clear, and it is yes, recession. Subacorn says, will you still confirm EU and Japan are all still good moves for AWS? Can you help explain more? Well, I've got a, previously we had a 25% exposure to equity. And our model told us that we need to increase that exposure. Our model also told us, we use our FVMR strategy to do the allocations. Our model basically told us not to allocate to the US. And I think that when we see a recession coming in the US in the beginning, what we'll probably see is that the US market will come down quite considerably. And remember, it's very highly valued versus the EU and Japan. So they have less of a ways to fall. And the ultimate result is that I think that Japan and Europe can hold up relatively well relative to the US dollar, and particularly to the US market if we crash. Now, once we crash, I think eventually the Fed is going to do some quantitative easing and we move into QE infinity. And basically at that time, the US market could take off. But by that time, we'll be reevaluating our portfolio. So we make no change to EU and Japan. All right. Patnari says, is EU small cap stocks good to invest? Yeah, I mean, part of what we're playing right now is a hope that we see some continued momentum in the European Union. We've seen the EU markets starting to come up, and we know that the EU small cap is more volatile. So we're trying to catch some of the upside in the EU market and add in a little bit of volatility in the EU small caps. So if we are right, the small caps may even outperform the EU markets. But If we're wrong, of course, the small caps will get hit hard. Of course, I don't think that you should be looking at EU small caps as one thing to invest in. Always be building a portfolio like we're doing. ABB says, how about CRE, commercial real estate, as mostly owned by small banks and other bank crisis coming? That's part of the reason why I feel nervous about the regional banks, because we know how much increased interest rates impact the property market in the US. And so I would say that there's still a risk. And the problem about the commercial real estate is that it's not packaged in a way that a bank can easily sell it. Mortgages, so home loans, are packaged in a way that they can easily sell them to the Fannie Mae or Freddie Mac. And so therefore, I would argue that commercial real estate is a problem area. And that's part of the reason why I think the Fed's going to start buying mortgage-backed securities in the next month or two, because by doing that, at least the regional banks and the smaller banks can offload any mortgages off their books. So now they can offload any government bonds, and they can now, I'm saying that next they'll be able to offload any mortgage-backed securities. Of course, the Fed could solve this problem by cutting rates. What's causing this problem? Raising rates. So if we go into a recession and we see the Fed start to bring down rates, it's going to take pressure off of the financials and off of many of the companies. And the result is the financial sector, if Fed started reducing rates, financial sector may actually do very well. Salia says, will S&P hit new low during the recession? I don't know about new low, but yeah, it's going to come down. The S&P is going to come down. And how much? I try not to pick like the exact amount, because I did that for 20 years as an analyst, and I realized that it really is very difficult to do. So it's probably not worth it. All right, Lana Fernandez. Let's see. AWIF is not performing well, but it still has 10% in the port. Well, keep in mind that for anything in the port, there's many things in the port that aren't doing well at times. And basically, we are constructing a portfolio, and we revisit that portfolio every 3 months. If at 3 months, we decide that we want to get rid of anything, we do. But we try not to react, because if we react to say, this one's down, let's get out, this one's up, let's get in, or something like that, you end up doing two problems. Problem number one, you make a lot of mistakes because those are emotional moves. Problem number two, you bring on a lot of fees, and fees bring on a lot of costs, and we try to keep the costs down. So yes, there's many things that are underperforming, but we're constructing a portfolio and we're going with it over the period of time. Subicon says she's going to study BBA finance, so bootcamp provided her a strong foundation. Yeah, she did really well. And I know she had to get her tooth out during the bootcamp, so she was under a lot of pressure, but that's great. All right. ABB says ECU is rate hike still next round. EU will be in recession soon, or not the case anymore. I think EU is probably still raising rates, although I think they'll slow down now that we saw inflation come down quite dramatically. And yes, I think that Europe is also going to be in a recession, but I would say that the stock market in Europe is much less highly valued than the US. So a recession can hurt in the US, it can hurt in Europe, but from a market perspective, I think it would hurt the US more than Europe. Gan says, which sector in the US I should focus for now that can prevent me from recession effect? Well, keep in mind that for recession, you want to be, first of all, in gold and bonds. So those asset classes tend to protect during a recession time. And then you want to be in defensive sectors like utilities and consumer staples and healthcare, as an example. Those are some of the ones that you would be in to try to protect against a recession. Now, in my case, as far as the U.S. is concerned, for our strategy and a recession risk, basically what I would say is that we've just reduced our exposure to the U.S. to try to cover ourselves from a recession risk rather than just rotating sectors. Now, the question, one of my team, Alex, sent me a message, and he was just looking at this question. And Alex wrote, Krung Thai Long-Term Equity Fund, LTF. We don't have that fund in our strategy. What we have is the Bua Luang Global Equity Fund. Now, it's possible that one of the advisors at Phenomena advised you to get the LTF. But as far as our strategies are concerned, what we have is the Bua Luang Global Equity Fund and also the KKP Passive Global Equity Fund. Alex, maybe you can share that into the chat just so that it's clear. All right, next. Peter Pan says, when you said that there will be a recession in the next 2 to 3 months, is it possible that world stocks have already bottomed and world stocks will go up instead? Yeah, that's an interesting question. I think world stocks are definitely a lot cheaper. But one of the lessons I've learned is that when the US gets hit, the whole world gets hit. So it's hard to see a recession hitting in the US and stock markets outside of the US going up. So I am not sure about that. Now, would the world stocks go up less, or sorry, go down less? I think it's possible. So that's what I would say about that. Next question. Do you have any idea how long the US recession will last? Well, this is why I say that we are in QE infinity, because I believe that the US will do whatever it takes to prop things up. And that means that they'll switch from quantitative tightening to quantitative easing, which I think they've already done right now. And basically what we'll see is that they'll try to prevent the recession from being too long. And I would say that we probably have maybe a 6 to 12 month recession. I don't think it's a super long recession because we've already been through a lot of ups and downs. And so that's what I would say about that. Mother Mort says, to what extent is the U.S. recession still affect SCB comp? Well, it's going to affect any of the different equity funds that we have. Everything will be affected, and that's part of the reason why we have gold. That's part of the reason why we have bonds. The objective is basically, that it's going to be it's going to affect everybody. Now, as far as commodities are concerned, basically right now we have 5% commodity exposure in AWS and 0% commodity exposure in the other strategies. So we have gotten out of commodities basically. And the result of that is that if we see a recession, it's generally a time that commodities underperform. And that's the reason why we moved out of them. And so as far as what will happen with commodity funds and others, like SCB commodities, I think it could come down if we had a recession. So be careful. So how I don't think I've ever gone live and not been asked a question about Vietnam, but it almost happened because we're almost at the end of today's live session and nobody asked me about Vietnam. However, somebody just did. Supercorn asked, how do you see Vietnam as of now at quite low price? Nope, still negative on Vietnam. It has not come in our model. And also, when I look at interest rates and I look at inflation, I would say it just still is not on my radar. So maybe in 3 months, maybe in 2 months, maybe in 6 months. I'll just have to revisit it. But the last time we revisited Vietnam, it was not on our radar. So that is a negative view on Vietnam, basically, or let's say neutral to negative. ABB says U.S. recession this year, a pre-election year, good before a QE next year, election year. Yeah. And yeah, next year's election is going to be fascinating. You know, I don't think Biden's going to be the nominee for the Democrat Party. And they better hope that it's not Kamala Harris, because I think she's going to have a very hard time. Robert F. Kennedy Jr. has just put his hat in the race for the Democrat Party, and he has a fantastic ability to get independents to vote for him and to get Republicans to vote for him. But he will have a very hard time having people in his party vote for him because they hate him. So it's going to be a fascinating watch. I think that Trump is going to be the lead, the forerunner. And then my prediction, which is a bit of a wild prediction just off the top of my head that I've been thinking about, is that Trump will be the leader, DeSantis will be number 2. And just before the election, I think that Trump may hand it to DeSantis, and then DeSantis becomes the Republican representative. And then Trump, stands by as a power broker in the Republican Party. And also that allows DeSantis to pardon Trump if he's under any convictions. Okay. Patnari says, will next generation infrastructure stock prevent my port from coming recession? Generally, we can say that infrastructure funds are defensive because it's government spending. And so recessions tend to not impact government spending. Also, infrastructure projects tend to be long-term in nature. So we wouldn't see, unless it was a terrible recession, then I would say that the infrastructure fund should be defensive in the recession. All right. Anyone else have any questions? We're just a few minutes away from ending, and I want to end by, thanking everybody. I know sometimes when you listen to me talk about the strategy, you want me to do more action. Why don't you get out of this? Why don't you get into that? But I can tell you that the whole purpose of what we're doing with these strategies at Phenomena is that we're trying to be stable, structured, and bring a long-term view to it. And that's our goal. And so we'll do our best. Let's see. Final questions. How about India? Any risks or opportunities you foresee? Well, we've exited India. We were long India for a while, and we've exited that position. So I would say for right now, I'm not interested in equity. In Indian equity. Peter Pan says, this year I gained 6% in MSCI All Country World Index. Should I switch out? Well, first of all, remember, for everybody on the call, I'm not your advisor. You got to talk to your advisor either at Phenomena or if you have another advisor, because I'm talking about an overall strategy, right? But if you ask me about All Country World Index and a 6% return, I would say that I try not to move positions just because, let's say, I got a return in one. Ultimately, you want to keep your winners running. But if you are overexposed to equity, and as I've said, the U.S. I think has some risk, then you may trim that. But if All Country World Index is a small part of your strategy, like it is for some of our strategies, then I would say I wouldn't make major changes. All right. You are welcome, Jarvis. And there we go. Taling Ping. Oh, yes, that's a great one. I love that one. And I used to go to Central World for that one. So that's another great recommendation. All right. That is everything for tonight. Those are all my thoughts on the markets, the strategies that we have. I'd like to end it by reminding you, we're global, we're diversified, and we're long-term. So that's why we have been successful over the years, is because we stay focused on those three things: global, diversified, and long-term. And I'm happy to have everybody with us in these strategies, and I'm happy to have all the questions that we get. So I want to say thank you to everybody, and I see some lovely thank yous coming in, and I appreciate that. And I just want to say for everybody to have a great Songkran. I'm going to take my mom out and we're going to drive around and watch the splashing and all that. But everybody have a great Songkran, be safe, and I will see you in a month.